Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Edward Ring. Edward founded New Standard Equities in 2010 and serves as its chief executive officer. Edward has transacted over $2 billion of real estate over an illustrious 25-year career. And in just a minute, we're going to speak with Edward about the relation between interest rates and cap rates. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Edward Ring. Welcome to CRE PN Radio.
Hi, thanks for having me. It's a pleasure to spend the morning with you.
Well, I'm looking forward to our conversation. But before we get started, if you could share with the listeners a little bit about your background.
Sure. I've been in the multifamily real estate space since 2002. I was working for another company for about 8 years when the Great Recession hit, and I decided to do what I was doing for them for my own book and my own investors. And I was full of hubris and ignorance, and just enough to keep the blinders on the things I didn't know about, and enough to give me the courage to try to do this on my own. So it's been about 13 years now, and I've got currently about 2,000 units in my portfolio. I do strictly value add apartment investing, and I own and operate and manage the investments with a team, of course. We're about 60 strong or so on the employee side. And I stick to the markets that I know. I'm in greater Seattle. I'm in Northern California, I'm in Southern California, and I've been farming Denver for the better part of about 4 years. So eventually we'll be in Denver as well. I use equity from anywhere from mom and pop type investors to large institutional equity sources and all parts in between, family offices and whatnot. And my debt, generally speaking, comes from Freddie Mac, Fannie Mae, debt funds, banks, kind of whoever's giving us the best rate at the moment in time. All non-recourse. Talk about risk. I don't want to lose my house over this stuff. I'm very, very cautious. Some of my peers are more cowboys, and I tend to be very slow and steady, wins the race kind of character.
No, I appreciate you sharing that kind of your background there. So you've been doing this long enough to see the front end and the kind of the back end of a cycle. I feel like a lot of people I speak with are kind of all post the crash where everything was so low that you didn't really have to know anything. You just got in at the right price. You could write it up and get out and make some money. Because if my math is correct, 2013, or excuse me, 13, I guess you were at 2010. So it was kind of post crash. Is that kind of the when you got in as far as doing it on your own?
Yes, exactly. As far as going on my own, there was a small recession in the early 2000s, 2001 to 3-ish. And of course, I saw what was going on in that. And interestingly, the folks I was working with back in the early 2000s had gone through the previous downturn and recession and the credit crisis of the early 90s. And that was fascinating because everybody that I learned from and my mentors and whatnot were all veterans from multiple cycles. And for sure, it's a pretty interesting time right now because I too am meeting all sorts of people who jumped into this business in 2010 or 2011 and had never really experienced what it means to sign on the dotted line and what it means to have, a credit crisis or fundamental changes in the macroeconomy where your values can get impacted. It all looks so easy from afar, but it's far from easy.
No, well said. So I'm kind of curious, when I have these conversations, a lot of times what I find is that there's a viewpoint that what happened last time that caused the crash is, and this is more like a pre-crash conversation. And I'm not saying we haven't crashed yet, but there's certainly been a slowdown right now. But the want is to look to the past and identify what caused the last crash and look for those signs on the horizon for the next crash. Clearly the 90s was a credit crash. You said the mentors you learned from, and if I remember right, was that not like the savings and loan kind of debacle that kind of came undone with I don't remember what the circumstances were.
Yeah, that's effectively correct. And
Okay.
it was way back then, you're talking about a system that didn't have really didn't have the internet. I mean, that's how long ago it was.
Right.
And that really that information flow changed everything. Obviously, it changed. We hear about it all the time, but when you really think about commercial real estate and what's gone on, you went from a system where it was a weird thing to invest in an apartment building because who knows what's going on, and wait, you got to fix the toilets? I don't get it. There's a lot of weird stuff out there, and people are like, oh no, you can make money by investing with this guy from Chicago. It's like, oh my god, it just sounds terrible. Well, then the internet comes around, and the last big recession, with 2008, we can talk about that in a minute, but all of a sudden you had asset managers at banks who were, all of my peers and mentors and people who had been around were like, oh no, the banks, they don't want to own this stuff. The banks are just going to take it in the chin, and don't worry, you'll buy it pennies on the dollar. Well, not so much. In 2008, there was this thing called the internet, and there were things called cameras that you could plunk on, put on your computer desk and take a look at the asset. And even in 2008, we had that technology. And so now all of a sudden, you have banks that are now populated with highly educated people who aren't necessarily afraid of this thing called an apartment building, and they're not necessarily afraid of what they don't know, and they're willing and able to jump in with 2 feet. So what everybody was afraid of, or what everybody was excited about in 2008 and 9 was, oh, we're gonna go make a ton of money because the banks are going to take it on the chin. And no, that didn't happen too much. A little bit. Some borrowers and some owners really got in over their skis and bought in markets that they didn't understand or whatever. And sure, there were some losses. But cut to today, And the most fascinating conversation I had, I think, was really at the front end of this thing back in June. And again, we don't know where we're all heading. I have a hunch, but back in June, I had a extremely sophisticated, very, very intelligent investor, institutional investor, manages billions of dollars. And he's literally one of the smartest people I've ever met. And he pulled out of a project that we were trying to buy. And he said, Eddie, I know where this is all heading. I remember 2008. I know where this is all going. I was like, really? You're the most sophisticated guy I know. How do you know where this is heading? And he said, yes, with total straight face. And I said, listen, I can tell you one thing for sure. One thing for sure is it's not going to happen the way it happened in 2008. That's the only thing I know. In fact, nobody knows anything about anything except for no things happen in the exact same way each and every time. If they did, that's called a crystal ball, and everybody would make money, I guess, or everybody would lose money. And think of a world where everything happens the exact same way every single time. First of all, it'd be pretty boring. Second of all, that's not the way human beings are. So now the question is, well, what's going to happen in this next go around? And that's where I've been mulling a lot recently and trying to think through the various factors and prepare for a downturn, prepare for the worst. But however, this is not 2008, 2009. That was the scariest time I've ever seen in my life, not just as an investor, but as a sophisticated person who reads the news and watches what's going on and understands what's happening with credit markets. That was a really, really scary time. We were very much on the brink of an entire financial system collapse. And so if you think about that and you cut to today, we have some inflation. We have a group in Washington dialing up the interest rates. We don't have anything remotely close to what it looked like in 2008. And in fact, we've got full employment. We've got lack of employment. We don't have enough people to fill the jobs that we have out there. So, a bunch of layoffs in the tech industry right now. And, you open up the newspaper and hear about somebody else laying people off, but that's actually normal. It's a normal course of business. That doesn't necessarily mean that we're facing a ginormous credit crisis and everybody should run for the hills.
No, I appreciate you kind of going through that, and I'm a believer, like you say, that whatever happened last time is not what's going to happen this time. That's too easy, and a lot of it is because the holes get fixed, or like in the instance where you're talking about the 90s, where it was pre-internet, and now we have the internet. That's a whole lot of information coming at everybody that's available 24/7, 365. As opposed to some sort of a local on the street kind of knowledge that may not be available to everybody. So let's talk a little bit about kind of the where we are now, and then if we however it works best, talk about that relationship between interest rates and cap rates, because I think one of the things that people historically, the interest rates we're at today, the mark would be doing cartwheels on the broad, the broad spectrum of time. But having come from such a low interest rate environment, it's a shock to the system right now. And my sense, and I guess my question to you is, do you think that the market will accept this and continue forward, or will there be a complete stoppage, and the recession, and then the need for the low interest rates to get the market going again?
Yeah, it's a great question. And I think that when I really look at the landscape and I think about where we've been and where we're heading, first of all, there's a couple factors. From call it 1980 through the early 2000s, all apartment buildings were bought with negative leverage. Leverage was always the price of debt was always higher than the cap rates, or very frequently higher than the cap rates. And people got used to figuring out how to buy real estate in that kind of debt environment. If you had equity, you just buy with equity, because why would you pay a lender? We get to the later part of the 90s, and now all of a sudden, early 2000s, now we're talking about leverage costs of debt that's actually lower than your cap rate. So you walk into a project, and the more debt you can put on it, the higher return your equity is going to get. That's how the math works. And so everybody got pretty excited about using that. Call it right about when I got into the business. So right around 2002, borrow at 4% or 4.5% and buy a property that's throwing off a 5.5%, NOI yield. That feels great. And in some markets that was a 6 versus a 4.5, or a 7 versus a 4.5, and some markets that's a 4.5 for a 4.5. But either way, everybody got used to the idea that was part of the calculus that would be there forever. And again, things change and things move around, and people who are buying these things with financial engineering in mind are not looking necessarily at the proper metrics. Just because you can buy a 7 cap somewhere and finance it at a 4 doesn't mean you should be buying that property. There could be a lot of reasons why you shouldn't be buying that property, and we can talk about that in a minute. But today, last couple of years, cap rates fell because the Fed cut interest rates to nearly 0, and cap rates fell through the floorboards, and all of a sudden people are getting comfortable at a 3.25 cap. And the lower that cap rate, the tougher it is to dig out of it if if something changes. And so we were very slow in 2021, and we were very cautious. And I kept looking in my markets. We had a bunch of people not paying rent, and you couldn't kick them out, and it was still very, very, very challenging. But we tried our best to stick to our knitting and stick to our discipline. And some folks may have not done that, and they bought at a 3.5 cap, and today they're sitting at a 4 cap, maybe with some rent growth, and the markets are decidedly in the 5.5 kind of range. Well, those folks are underwater. And so at some point, if they don't have additional equity, or they can't do capital calls, then those properties will be sold, and the equity holders will take a loss, and maybe even the lenders will take a loss, depending on, again, where that property is. However, the other funny thing about today, and this is what makes me laugh every time I think about it, every single conversation I've had in the last 9 months is some version of the following: oh, there's gonna be a lot of opportunities out there. We're excited. I said, oh yeah, yes, we have dry powder. We've got billions. We have, how much money we've raised? Billions and okay, great, wonderful. All your dry powder. Well, and then I'd turn the conversation to their own portfolios. I said, well, what are you going to do on your own portfolios? Oh no, our portfolio is fine.
Right.
So nobody wants to look at their own stuff as saying like, yeah, I'm going to get rid of my junky stuff and buy this brand new stuff at 8 caps. Nobody's talking about that. They're just talking about how everybody has dry powder. Well, somebody has to have a deal to close, to sell. If nobody has to sell, and it's a little bit like the single family home market, and you want to talk differences between 2008 and 2023. The single family home market in 2008, there were tons of people with floating rate debt, and tons of people that are underwater in their homes and forced to sell, and there were a lot of things. Well, this time around, not only has there been fiscal discipline on the part of the lender side, in the last 10 years. But now we're coming out of this crazy time where people were refinancing their homes at 2.5%, 3%, 4%, whatever it is. But there is no sale pressure at all in the marketplace for single family homes. Very, very little. And so now, just like in the multifamily spot, if people don't have to sell, they're not going to sell. They're not going to sell and say, yeah, we're going to sell at an 8 cap just because. No, we're not. We're going to hold because we don't have to sell. We just refied. We've got a 30-year mortgage on my house. Why should I sell? You know, that kind of thing. So I don't know if you can look at today's market and say, yeah, there's going to be tons of deals gonna just materialize. But I can say that when the market fully resets, there will be a new cap rate. We won't be buying in the 3s anymore. We won't be buying, you know, across the country at the same cap rate, which we can talk about that too. We'll be bifurcating and diversifying what we think is a good deal in Des Moines, Iowa versus Hollywood, California versus Hollywood, Florida. You know, there's going to be a difference in all of those cap rates that we haven't seen really in the last couple of years. And that's driven in part by interest rates.
Yeah, it is. I love the comparison that you're making there about you know, in what created the market opportunity in the 08s is that people had to sell. They didn't have the revenue. They had a loan being called, or I mean, the capital markets dried up to where they couldn't meet their debt covenants, or you know, whatever those situations were. They were forces outside that were causing them to have to sell. Whereas again, right now, like you just described, if somebody's got low cost debt and their property's performing, what's the where is the supply of opportunity going to come from? Other than if there are markets where maybe there was overbuilding that occurred, or maybe you've got a debt that's coming due, or that has to be refinanced. Or I've heard a couple of stories where maybe a fund has a property, and because the stock market has not performed well, that they had to liquidate to rebalance their portfolio. And I heard about a group that picked up a property with 10-year debt that was only 1 year into the debt, at a great rate. I mean, they had to bring more capital than maybe you would have, but I am not hearing all of the stories just yet of all the opportunities that have been forecasted by those you've talked with, and many others. And I mean, there is a chance that this just could be kind of a boring cycle that is the new norm of business. But I guess the history books will tell us what it was, or after we go through it. So let me ask you about you've talked a little bit about kind of the compression, the cap rate compression that occurred, and I guess even going back before, like the 2000s, how debt was always more expensive to where the way people the performance of a property. I mean, it encouraged people to come with more equity than it did debt. Is it possible that that becomes the new norm? And if that is the case, what are your thoughts on how long it'll take for the market to accept that that's the new norm?
Yeah, great question. I definitely think that it is possible that is going to rapidly become the new norm. And I think that what we're getting back to, and this is, I think it's good for my business, but we'll see. But that is that you pay a lower cap rate, a lot of times cap rate is always a function of risk, and you're going to pay a lower cap rate if there's less risk in the project. And part of that risk comes from the market fundamentals. So we're here on the West Coast, and we get a lot of grief about our politics and a lot of grief about, this, that, and the other thing. But, at the end of the day, we've got a ton of jobs here. We have a ton of high paying jobs. And so if we're buying properties, even if we have to finance them at, 5-6% and whatnot, we can go and buy a project at a 4.5, 4.75 cap rate, even though there's negative leverage, because we know that our incomes here are so high and the jobs are so plentiful and this housing supply is so limited that we have a very good sense that we'll be able to move that rent in place up to basically cover ourselves. Maybe we're negative leverage for a year and a half, but within 2 to 3 years, we might be positive leverage if we put the right debt on. So all of a sudden, that opportunity feels a little less risky. And so we're willing to pay a lower cap rate for that particular play. Now, if you're buying something in a different, I don't know where other markets where your listeners are, but let's just, pick some market in the middle of the country somewhere, or the East Coast or something that I don't know, but let's pretend there's a market that used to trade at a 6.5, and lately it's been a 3.5. Well, in the last 2 to 3 years, they didn't necessarily add a bunch of high tech, high paying, supercharged jobs. And you're really talking about service workers and, retail employees and whatnot. Well, now you don't have the fundamentals that you could then make that bet that your cap rate was, that you were safe at buying a 3.5, 4.5 cap rate, because you could move that cap rate up as you could raise rent. All of a sudden you're stuck with the rent, barring maybe 2-3% a year or something increases, but by and large, your market is your market. And all of a sudden, that feels very risky if you're putting on a piece of debt at 5.5 and you're buying at 4.5, and you're in a market where that market growth is not going to happen. Now, how are you going to actually generate enough yield for your investors or enough appreciation so that when you go to sell your project in 3 to 5 years, you'll actually make money? So now all of a sudden that feels a lot more risky to me. And so that going in cap rate had better be a little higher than say what you're buying in California. So all of a sudden, what we saw in the last 3 or 4 years is just a real compression of cap rates around the country to a single kind of cap rate. Oh, this is the cap rate for an apartment building. Well, now I think we're going back to, no, this is a cap rate in Tucson. This is a cap rate in Los Angeles. This is the cap rate in Northern Cal. And each specific pocket, each submarket has its own risk measurements and its own risk profile and its own fundamentals. And that's why you have to be really, really diligent and smart about what you're buying and where you're buying it.
Yeah, I totally agree with you. I've definitely come to the conclusion that the cap rate does dictate. Will there be anybody behind me wanting to buy this when I'm ready to sell? If even when cap rates were crazy in the 2s and 3s or whatever in some of your bigger metro areas, and that I always felt like the one safety piece of security that they had was that market was not going to collapse. Whereas you get somebody that's all excited because it's a 10 cap, or something like that. I'm going like, a 10 cap, you better love that property because you may own that forever, as opposed to, something that's more in a market with jobs. I mean, the fact that you have said jobs, that's pretty key, because those people with jobs are the people you want in your property, right?
Mm-hmm.
And I feel like, with as cheap as capital has been for the recent past, it's allowed investors to, I don't want to say overlook jobs, because jobs have always been kind of that statistical point that you have to be able to identify What's the median income? What's the, how much rent can your potential tenants afford? But with we mentioned the internet. Well, shoot, the whole COVID it taught us that you could work remote, and so there was this kind of almost this thought that you didn't necessarily need to be in the market where the job was. You could be, um, at any point. And I think that by and large that has played out. And I think there's a lot of people that have relocated. Talk to anybody that's investing in office space, and they'll tell you certainly some stories about that. But again, it still comes down to jobs, and there's got to be some sort of concentration of jobs, high paying jobs, so that you can, whether you buy a property at a low cap today, will be cash positive or leverage positive here in a short amount of time. And I just think that kind of what I'm hearing you say, and what I'm kind of picking up from others, is just that there is a reset that's occurring. It's I'm assuming, and tell me, how long do you think, is there a timeline you think, or you believe that it will take for people to accept this is the new norm? I mean, I know we talked about, yeah, we think it could be, but is it like a year? Is it 2 years? Do you think it'll be 3 years when everybody just kind of accepts us? Or is this just everybody keeps looking for something different until it doesn't happen, and then they say, oh, I guess this is what it is?
Yeah, I think that we as real estate investors, as a group, are impatient, and I think I'm no exception to that. It's been, as far as I can tell, since about April of last year. So we're talking about, it's been 10 months now, where the Fed has really started changing the dynamics of our marketplace. With their intentions, good intentions or not, whatever whatever people feel that they're doing it. And they've moved rates so quickly, so rapidly, that investors haven't been able to find their footing, and by and large don't want to actually be a participant in a market where they really don't understand what the landscape is. And I think, and get my crystal ball out, but if the Fed pauses or stops or decides, hey, we've moved interest rates high enough, we've slowed the economy down, inflation is at a back to normal, our jobs are still plentiful, let's just wait and see now and see how this goes. I think then we're going to start getting real estate investors to really kind of jump back into the market. I think that if they can project what's going to happen, they're okay to invest. If that means they get rewarded at some point with interest rate cuts, then great, they'll take it. But if they presume interest rates are what they're going to be for the next 3 or 4 years, I think people will start jumping in sooner than later. And I think helping all of this, at least in the markets that we play in on the West Coast, is that our rents are, they've softened up a little bit, but for the most part are holding. And if we were getting, say, $1,800 for an apartment a year ago, we're still getting that $1,800, and maybe it's a little bit more. Maybe now we're getting $1,950 if we renovate the project or something like that. So we're actually still seeing fundamentals in a decent shape. So if that's the case, and we can work those higher rents through the rent rolls, then our cap rates will be rising. And somebody can turn to us in a year from now and say, hey, would you want to sell this thing at a 6 cap? Yeah, I'd be like, sure, why not? I could sell it at a 6 cap because my cost basis is really at an 8 cap now. And so if I'm selling it at a 6, it's great. I'm going to do well. Now, if I am forced to sell early and I haven't been able to move the rents, then, well, I may be pretty upset, but I might have to sell anyway, in which case, we go back to, what it was like many years ago with having to sell into a market that we prefer not to be in. So.
Right. No, I think that that recognition and understanding of the cap rate, obviously it's a market. It's a market cap rate, like you said earlier. It's not a nationwide cap rate, although that's kind of what it was portrayed as more recently. But definitely each market has its own cap rate, and to be intimately familiar with that and understand the likelihood or the possibility of it moving. I would expect that it's probably wise to assume it will go up. So if you're getting a deal and you have an exit strategy plan that you plan for something a little higher, but or at least have a plan to be able to hold through, whatever is immediately in front of us. Let me ask you, because I think this is it's probably a question that seems obvious to some people, but I'm always kind of curious about this. How do you see the commercial debt, just the structure of commercial debt, and does it not kind of create the cycles in the market all by itself? Meaning, if you have a low rate environment and people either rush into the marketplace and buy or refinance, does it almost create a a natural cycle for when that debt's to be refinanced or extinguished, or does it, or is that just part of the operator's uh, Rubik's cube that they have to solve for?
Yeah, I think it's a little of both. I think, over the last 20 years, we've seen commercial lending take on a very interesting characteristic, or maybe it's been going on more than 20 years. But for sure, I see it today that commercial lenders are really just investors. And so they're just investing in a substack of the capital in a particular project, with between 1% and 70% or 65% or so. But at the end of the day, all those folks are investing, and they've got investors, and they're mining their ship for what they've promised their people. And gone are the days of the local bank, Mr. Potter, and you could go get your loan. That those days are so far gone that now it's everything's been sliced and diced into bonds, and those people have investors, and so everybody's basically an investor. And so and there's a lot of creativity in investing, as we all know. And there's a lot of creativity in structuring debt. And so yes, what you're saying is quite true, which is the more creative the lenders get, the more they're able to offer a lower interest rate, because they're making certain fundamental assumptions that the next lender's not making. Again, trying to arbitrage and squeeze out a little bit more yield for their investors and do a little bit better. So when time for bonuses come in February, their bosses are all happy, and everybody goes home and celebrates. That kind of competition really mirrors what goes on in the operator space, where we're going to chase apartment buildings with 5 other groups, and we're saying, yeah, but we think we can do XYZ, so we're going to pay a little bit more. Well, if we're right or wrong, that's kind of where the rubber meets the road, and the same exact dynamic is happening at the lender level. Problem at the lender level is the losses could be even higher than, say, the losses at an operator level, even though it might feel worse, because losing all of your equity in one deal was a terrible feeling, but a lender could lose tens of millions more, and that is a much, much larger loss to bear.
Yeah, that's that old saying, if you have a $5 million loan, that's a you problem. If you've got a $500 million loan, that's a bank problem.
Exactly.
Kind of thing. So
Yeah.
definitely. Hey, Edward, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically look to consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be their clients, investors, tenants, the market, political, the Fed, however you would like to frame and consider the question, what is the biggest risk? And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Edward Ring, what is the biggest risk?
I think the biggest risk I'm facing right now is not having the patience to get comfortable with the knowledge base that I have and what I see on the horizon. So I'm a person that tends to slow down when other people are rushing. They want me to make a decision quickly, so I peel back and take a moment, take a pause. I do my best work when I'm thoughtful and I assess. And I think that that's the risk that most humans, not just in real estate, but that most humans face, is that they are making decisions without actually understanding the fundamentals surrounding the problems that they are faced with. And I think that folks out there would do well to get educated and to really make sure that they're arming themselves with intelligence and intelligent reporting so that they understand the markets that are in, they understand the risk reward calculus, and they understand what they're facing. And if they understand all of those factors and are comfortable with them, then it's pretty easy to make the right decision, or at least a decision. And time will tell if it's been right or not. But at least you're eliminating the one single factor that everybody has, and that's your own ignorance. If you can eliminate your own ignorance, man, you're going to do great.
No, that's a wise man speaking there. That's good stuff there. I appreciate that. Hey, Ed, where can the listeners go if they'd like to learn more or connect with you?
Yeah, newstandardequities.com. You can send us a note. I think we have info at, and I think there's investors. There's an investor portal if anybody's interested in investing with us. You just go visit our website and click around. You'll find it pretty easily. We're very cautious, so it's not like you're going to go and see 1,000 deals like a crowdfunding platform. It's a couple a year maybe. So I welcome people to hop on our site and become one of our investor members, and we'll see what happens. Hopefully we'll find some decent deals out there. Got
it. Well, Ed, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I learned a lot, and look forward to doing it again soon.
Cool. Anytime. Take care.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.